here with Will Allen.
Take three.
Take three. Hi guys, my name is Evan Temple. We're here with Will Allen of Centaura Capital, and I've been a client for over 14 years. Amazing to think that. I'm only 41, so that's a long time. And they've been helping me protect my money for a long time. We got a lot of things going on in the market. I think clients like myself, some of us watching, want to know what's actually going on. And then I want to ask you about the housing market, because I've got some questions about whether I should sell, buy, what we should do. And you've got all the graphs and the data that I don't want to plug through. So go ahead and take it away.
Exactly. Well, let's talk about where you started, talking about the U.S. economy. Okay, how's the economy doing? What's happening there? So one thing that's important to note is that last year in March, the Federal Reserve started to increase interest rates.
Okay.
And one of the reasons, the main reason they were doing that is to bring down inflation. You know, inflation was out of control. Everyone understood that. They started to aggressively raise rates. And one of the goals of that is to cool down the economy. And
when you say cool down, that means it's getting out of check.
Yeah, they just wanted to slow it down, because a lot of times when the economy is growing hot, okay, when the economy's on fire, consumers are spending a lot of money, prices go up.
And they start to gouge you.
Exactly. Yeah. Well, not even just that, supply and demand. Let's give an example like airlines, right? Yes. If you have too many people, you had a situation where everybody and their brother wanted to fly, right? Wanted to travel. Yeah. They stayed home in 2020 and 2021, or a lot of people did, so a lot of people wanted to fly. Well, there's only so many flight crews and pilots and
so they're going to start to charge a lot of money.
Right, well, exactly. When you have all the demand, right, so all the demand for the tickets, and you have fixed demand, so prices are going to go up. It's just a law of supply and demand.
Got it.
They wanted to cool down the demand for tickets, to bring the prices down, and that's one industry, but kind of across the economy, the Fed wanted to kind of cool it down a little bit. So they started to raise interest rates, and let's talk about how that might affect like a small business, Evan. So if you're a small business, and a year and a half ago, you needed funding.
I need some money. Okay.
Yeah, so you could go get a loan for 6, 7, 8%.
Pretty good.
Okay, at that time, exactly. Well, now, after the Fed has aggressively hiked interest rates, those rates are 13, 14, 15%.
Oh, gosh, I didn't even realize it was that much.
Yeah, so it's a lot more expensive, right?
Up to 15.
So you are going to be less likely to go out and borrow, because that's not very attractive, right? You know what I mean?
Yeah.
So that's an example of how rate hikes can impact the economy in certain ways. So that's what the Fed was doing last year, and a lot of economists believed that by the time we got into 2023, that the economy would go into a recession because of what the Fed was doing.
And I'm hearing that a lot from the news. They sensationalize a lot of things. And a lot of my friends, too. Everybody's kind of hunkering down. And I was wondering your take on that, because I think you're about to tell us that it's doing better than we thought.
Yeah, well, the economy, in fact, the opposite of what a lot of forecasters had projected is the opposite has happened so far. So let's give an example of that. One measure of the growth in the economy is called GDP, the gross domestic product, and that's just a measure of how fast is the U.S. economy as a whole growing. So to give you an idea, in 2022, it grew at a pace of around 2% for the year. Okay. So then we get into 2023, and the data we have so far is in the first quarter, the economy grew at 2% again. So kind of same rate that we saw last year. Again, a lot of these forecasters thought that would be declining. Okay. So not growth of 2%, but a decline of 1% or 1.5% or something like that.
Right.
So the first quarter, that no decline. In fact, we saw growth of 2%. In the second quarter, so we're talking about April, May, and June, the most recent data says the economy grew at 2.4.
Okay, I'm going to have some questions for you after this. Keep going.
Yeah. What you need to know here is that is higher than in the first quarter. So the economy is actually accelerating.
The economy overall is accelerating.
Yes. So The most recent data that I want to give you is something that the Atlanta Fed has a tool, and you can go to their website, and they call it GDPNow. So it's their prediction based on data that's come out so far of what the third quarter growth is going to be when we get it in late October. So we still have some time
What are we at
before
right
it actually
now?
comes out.
What do we think they are?
Well, right now, the Atlanta Fed has a projection of 5.9%.
Okay, so I've got
5.9%.
First of all, why don't we know this? This is good news.
Yeah.
And I'm going to ask, okay, when does this stop and does it start coming down? And 2024, what is that going to look like? So.
Well, look, the fact is that 5.9% is nobody in their wildest dreams a year ago would have projected that, a year and a half into the Fed's rate hike cycle, that the economy would be re-accelerating, go from 2 to 2.4. 5.9 is just absurdly good. I mean, it's hard to even fathom. A way to think about that is even if by the time we get to October, when the data comes out officially for the third quarter, even if it comes in at, say, 4%, that is remarkably good. Okay. And so,
can I ask you a question? Is that why these banks are if they're saying, hey, bring in $100,000, we're going to give you 5% because they're making a lot more behind the scenes?
No, not necessarily. Banks right now are in a little bit of a contest for funds. The banks that want the money.
Funds. Yep.
So first of all, your large banks, the big mega banks, which is J.P. Morgan Chase, Bank of America, Wells Fargo, and Citi. There's 4 of them. Yep. They're not paying anything close to 5% on money markets, checking and savings accounts. I mean, they're paying next to nothing because the fact is they don't need deposits. They have gotten billions and billions of dollars in deposits. They have more money than they possibly need. Okay. Sure. Your regional, your smaller banks. Exactly. Yeah. The regional, the small banks are in a situation, though, where they need to pay a higher interest rate. And so they're offering 4%, 4.5%. But sometimes 5% to get the money in. But let's talk about the economy for a second. And this is important. So the impact of higher than expected GDP, we got to ask the question, why is the economy growing faster than it was expected? Right. And there's a couple of key reasons. The most important one is the jobs market has been really, really strong. Do you remember back about a year and a half ago when everywhere you turned, companies were saying, help wanted, we can't find enough employees?
Weren't they saying it was up to around 9% unemployment?
Yeah. Well, the unemployment rate got above 10% in the early days of COVID. A lot of people were laid off. But then when the economy started bouncing back pretty quickly, companies reversed course and said, oh, my goodness, we need to get our employees back. And so they tried to go out and hire people. But the fact was, it took a long, long time for companies to be able to get enough employees to meet demand. Sure. And so so in 2022, the story in 2022 was finally a lot of companies were able to catch back up. Right. But the fact is, Evan, that even today in 2023, the Fed has aggressively hiked rates trying to slow down the economy. And a lot of people believed, okay, companies are going to start laying off workers. Yes. That has not happened. So let's look at a chart.
On the whole, because I do see on the news, AT&T's laid off X, Disney's laying off X. Disney's not doing good. They're their own thing. But on the whole, we're seeing an increase.
Yeah, so let's talk about that. Specific sectors. So, for example, last year, a lot of the big tech companies realized, hey, we overhired.
Had some bloat.
Yeah, they hired too many people, right? And so all of them, Amazon, Meta, Microsoft, all of the big...
Meta is Facebook for all of us people who...
Exactly. So all of those companies laid off workers last year. But the fact was, if you looked outside of big tech last year, there were not many layoffs. Now, in 2023, some of the media companies...
Oh, there we go. Love it. Has to happen.
There we go. Some of the... But so Disney... Yes. Paramount, some of these other, content companies, they're having their own kind of idiosyncratic issues. If we look across the economy, materials, healthcare, industrials, those sectors are still struggling to find enough employees, and they're certainly not laying off any employees.
Okay.
So let's look at this chart. This is the best way to see. Let's look at the U.S. economy as a whole, and this is something that is called initial claims for unemployment insurance. You understand, if somebody gets laid off and they don't immediately find a new job, they go file for unemployment. Yeah, so they file for unemployment claims. So this declined significantly in 2021 and 2022 as the initial impact of COVID that got further and further behind us. Yeah. Exactly. So take a look at what's happened over the last year and a half. The Federal Reserve has been aggressively hiking rates, so a lot of economists believed this was going to skyrocket, that we were going to start to see companies laying off employees because the economy is slowing. That has not happened.
Okay.
Initial claims for unemployment insurance is at the same place today it was a year and a half ago.
Do you see it happening in the next 6 months to 9 months to a year?
It's really hard to give a definitive prediction in the next 6 to 9 months. Well, it's hard to say, but I'll say this. We've been on the side for the last year. You look kind of at our blog post and for client portfolios. We've been in the position that the economy is going to be stronger than a lot of these analysts have predicted.
And you've been right. You have been right.
Yeah, we did not believe there would be a recession in 2023.
Right.
And we based it off of the jobs market's really, really strong. And we also based it on the fact that consumers are still sitting on more money in their checking and savings accounts.
How much more money?
Well, right now it's about 30 or 40% unadjusted for inflation.
Okay.
If you want to adjust for inflation, it's about, and that's important to do that.
Right.
You're talking about 20% more
20%
in
more.
your checking and savings accounts across the board.
And are people saving this because they're fearful, or are they about to spend, do you think?
Well, most of that savings came during the period of 2020 and 2021. Okay. In fact, we'll put a chart up that kind of shows, and y'all will notice.
Is this all stimulus money, or?
A lot of stimulus money and a lot of money that if the people who were still working, they weren't going out and spending money. They were letting their checking and savings accounts balances accrue and get larger because there was a lot of uncertainty at the time, right? Yeah. So it made sense. Hey, I want more money in my checking and savings account. But you can see that this basically went up for about 2.5 years. It peaked here in 2021, 2022, in that kind of middle time frame. So over the last year, we all know that a lot of travel, a lot of people going to ball games and restaurants, etc. Yeah, so you have seen that the amount of money in checking and savings accounts has started to slowly decline, but there still is a lot more money in their accounts than there was 2020. And I will add, that is no matter what your income level was.
Right.
So if you are in the lowest quartile here, under $50,000, today you're in a situation where you have basically 50% more in your accounts than you did in 2020. A lot of people aren't talking about it.
Let me break this down. So we're up 5.9%. We got 20% more cash in our pocket.
Yeah.
The market is doing better than we'd hoped. Yeah. A lot of analysts had hoped. So that's good for our portfolios for now, right?
Yep.
Talk about the housing market.
Yes. So let's shift gears on this because you mentioned kind of big picture. And the reason we want to talk about the housing market is that when COVID hit, one of the things, everybody was staying in their homes. So what happened is home values skyrocketed. Right. Basically, Evan, the way to think about it is
that across America? Because I know we're here in Georgia, and it's nearly doubled. That's everywhere.
Yeah, and so we have clients in Nashville, in Florida, in Texas, in Phoenix, in Vegas, a lot of parts of the country, and pretty much in every one of those parts of the country, home prices went up between 30 and 50%.
Yes.
In a 3-4 year period of time.
Okay.
So
that's good.
Why does that matter? So what has also happened in the last year and a half is that mortgage rates have gone up substantially. In fact, let's put a chart up for the folks. The 30-year mortgage rate hit 7.2% last week.
7.2.
Yeah.
And for a lot of people, they don't understand how that impacts their payment.
Yeah.
And it's everything.
Yeah. So let's talk about that. So 3.5 years ago, right before COVID hit, okay, your average home, if you wanted to go out and buy a house, the median price of a home sold was $268,000.
$268,000. Okay.
And a mortgage rate at the time was 3.2%. So what did that mean? That meant your payment before tax and insurance was just over $1,000 a month.
That's nice.
Okay, so that's what it was at the time.
Yeah.
So 3 years have gone by.
Right.
Home prices have gone up substantially. So your current, let's get that chart back up here. The existing price of a home last month, $416,000, up from $268,000.
Up from $268,000.
Okay,
almost
so that's
double.
a big jump.
Yeah.
The mortgage rate was at 3%
Right.
back 3 years ago. It's at 7.2% now, so that's more than double.
That's more than double, yeah.
So what does that mean for your payment? It means your payment is over $2,500 a month now, compared with $1,000 a month just over 3 years
I don't
ago.
like those numbers.
Yeah, I mean, that's a huge increase. And, one of the constants...
Yeah, break that down. What do people need to do with that information now? Because I'm like, okay, I've got a big house. I've got a good interest rate. I think it was 2.9.
Yeah.
So obviously I like that. That's the cheapest money I'm probably ever going to borrow. But then I'm also going, okay, well, is the housing market going to tank? And do I need to get out of this big home?
Yeah, I don't believe, so far there's nothing to indicate that there should be home prices tanking.
Okay.
And one of the reasons for that, so let's take a look at a time that we did see housing prices tank, which was 07-08,
Yes.
the financial
Yes.
crisis, okay? So there were two key reasons that home prices went down 30%, 40% during that time. Prices did tank. Two reasons. Number one was that in 2004, 5, 6, home builders went wild,
They did.
building everywhere
Overbuilt.
they could. They overbuilt. There were so many homes for sale. And,
I remember.
home prices are just like the prices of anything else. It's a supply and demand relationship. At that time, you had excessive supply.
Mm-hmm.
When the financial crisis hit, demand dropped. Not many people were wanting to go out and buy, and so prices went down substantially. Exactly. The other thing that took place in 05, 06, 07 were that mortgage lenders started lending to anyone who could fog a mirror. You know what I mean? You could get $1 million mortgage making $50,000 a year.
Go watch the movie Big Short.
Yes.
That'll explain it great, right?
Exactly. The Big Short really, seriously, does a great job of explaining it.
That's good. That's good to hear from a professional that they actually nailed it.
Yeah, they did nail it. And so the fact was that there were a lot of also subprime mortgages out there, and so those folks could not afford the mortgage payments.
Got it.
And so you had a lot of homes go into foreclosure. That's more inventory.
Yep.
Home builders building a lot. Now you've got homes being foreclosed on, those going on the market. Just way too many homes. Actually, the problem right now, Evan, that we have for home prices is that there aren't enough homes. For two reasons.
Can I ask a question before you say that?
Yeah.
So is that the reason why we're seeing BlackRock and Vanguard put all this money into apartment complexes, especially here in Georgia? They're everywhere. They're ramping them up. Is that why?
Yeah, that's exactly, because they know, hey, it is darn pricey to go out and purchase a house. You're going to pay $2,500 for a mortgage right now. That's expensive. So let's get more rentals out there to give people an option. But you just mentioned you have a rate at 2.9%.
Locked in.
So half the country has mortgages under 3.5%.
Half the country does. Okay.
Yeah. So the fact is, knowing that mortgage rates today are above 7%,
they're going to wait.
You're not going to sell your house.
They're going to wait.
Yeah, you're not going to give up your 2.9%. So that's one of the reasons that home prices today have not declined significantly, because there's not many homes on the market.
Okay.
If you had a surge of people putting their homes on the market, home prices would drop a lot. But that hasn't happened yet. So I don't believe we're going to see home prices fall like they did in 08, 09.
Okay.
And let me also add that...
So our home investments, that's pretty stable.
Yeah, and let me also add that the mortgage origination firms this time around, they learned from 08, 09. They did not lower the standards back these last 3 or 4 years. They did not lower the standards for making a loan. So they kept tight underwriting, which is good because you got people.
Well, they'd
who
be filleted alive this
houses.
time. I think they know they're not getting away with it with American people.
Yeah.
At least
the
this
second time.
They'll figure something else out.
Yeah. Of
Okay,
course.
so let's break it down.
Yeah.
So we're doing good on the market side. Housing, we got crazy interest rates going on. Let's say I wanted to pay off my house. Or invest, or what do we need to be thinking as the average person? And or do I put more money in the market right now? Do I keep cash? What do I do?
Well, first of all, the time to pay down your mortgage and to really work on that is if you have a really high interest rate.
Sure.
If you have an interest rate at 6-7%, you're going to want to pay that down faster. If you're someone who has a rate of 2.9 like you have, and a lot of people are in that 2.5%, 3.5% range, you actually can make 5% and higher in
the market, yes.
1 year, well, not even in the market, in a money market fund, in 1 year treasuries.
Right.
We have, like for you right now, we have you in 1 year treasuries paying 5.2, 5.3%.
Nice and stable.
Why pay down? Well, you're making almost twice as much in interest as the interest you're being charged on the house.
Right.
It makes no sense to try to pay down your house faster in your situation when you can make twice as much with no risk.
See?
You know what I'm saying?
Yep.
So that's to help answer that question.
Okay, got it.
Let's talk a little bit about the market, like you talked about there when you were asking kind of the market outlook.
Right.
This has been a really good year in 2020 for the stock market.
Yes.
And again, the main reason that we positioned clients this year, we positioned that the economy would continue to do better than expected.
And you were right.
And that has happened so far. Yeah. Now, one of the things that we're going to watch closely in the next 3, 4, 5 months is the Federal Reserve has aggressively hiked interest rates.
Yes.
So far, the economy's been able to handle that. But just because the economy's been able to handle it so far doesn't mean it'll be able to continue handling it. Let's talk about something that we talk about with clients, give an analogy.
Okay.
Let's say that you are a hiker and you're out at a mountain and you're hiking and you have a backpack on.
Okay.
And we say, look, Evan, every 50 yards, we're going to take a little rock, a small one, and we're going to put it in your backpack.
Okay.
Okay?
All right.
And you go 50 yards and we put another one in the backpack.
Yep.
Okay? We're going, if you say, okay, guys, stop putting these rocks in. This is getting kind of heavy. We could say, well, Evan, it's just a little rock.
That's right.
It's okay. You've been able to handle it so far, and maybe you have handled it so far.
That's right.
But we know there's going to come a time when we put one in that is
it's going to break your back.
It's going to topple you.
The
and
proverbial
it's the
straw.
It's the straw that breaks the camel's back. And so we're saying that about the Fed, that we hope that they realize, because so far they have kind of talked, they've given some clue that they understand that they don't want to go too far, but they've also said some things to believe that, hey, the economy's handled this. We could hike more if we want down the road.
Whoa.
But the fact is that there's...
And you don't think that's a good idea. You think they need to cap it.
We think it's a huge mistake if they hike anymore.
Got it.
We think mortgage rates up at 7.5%. If you're a small business, you're paying 14, 15%. That's high enough.
Roger.
There's no reason to take rates higher there. And, it's really what we're worried about here if the Fed keeps on going is really the opposite of what happened in 2021. Remember, that was the year that inflation was skyrocketing out of control, but we were being told, hey, it's temporary, it's transitory, don't worry about it.
Don't worry about it.
Yeah, the government and the Fed can continue printing money as fast as they can, right? And that was what we were being told. And what happened was by the end of 2021, the Fed acknowledged, oh my gosh, we got this wrong.
Right.
Inflation's out of control. And now we're going to have to come in with a hammer and aggressively hike interest rates, right?
Yeah.
So the concern here is that the Fed has aggressively hiked, but that they will keep going.
Yes.
And they'll go too far and eventually send the economy into a recession. So
What would do that? What increase would do that?
Well, we don't know, and that's the problem here. You
sure.
don't know exactly what is the actual rate that eventually will send us into to our recession.
We don't know what it can bear.
The Fed themselves, they don't know what that rate is. Our concern is if they hike more, and right now the market's projecting that they're done.
Yep.
And so we need to hope that they are.
Okay.
But if they hold off, at least for the next 3 to 6 months, the economy should be able to continue to grow at higher than expected rates.
Okay.
Yep.
So that's good news. I like everything you said. This is important that we know this stuff. A lot of people don't have any clue what's really going on. We see the election process. We see Biden. We see politics, and plays into the fear index, and everybody's like, "What do I do with my money?" I like the fact that we can come and get some answers from here. So let's say you're not investing at all, and you're just holding cash, and you're young, and you don't know what to do. What's your advice for them?
Well, if you're somebody who's young,
right.
The first thing that we recommend is that the first thing they build before they invest is build an emergency account,
fund.
So to speak. Yeah, an emergency fund that they know, hey, if something happens to me that and I have a big expense,
right.
that just my monthly income cannot handle, I want to know I can go pull it from an emergency account and can take care of my situation. Once you've built up an emergency account, which is typically anywhere between 2 months, 3 months of your expenses.
Okay.
What it costs to run your house. If you can get 2 to 3 months, if you're young, of expenses in emergency account, that's good. Fantastic.
Okay.
But money over and beyond that, absolutely you should start investing, because the bottom line is, if the market doesn't do well, if it declines, that's actually in your favor, because as you're buying, you're paying much less for the stocks that you're buying. Sure. You actually don't want the market at all-time highs if you're buying in, right?
Exactly right.
You want the market to drop so that you can buy in at those cheaper prices. Yes. When you're young, tune out all the noise, tune out projections of what the market's going to do in the next few months. Buy on a monthly basis, go in and purchase regardless. Right. You're investing for the long term at that stage.
Well, I know I had the problem of checking it all the time when I was trying to run my own little portfolio, and it did poor. So that's why I brought my money over to you guys. So I really appreciate y'all taking care of it. All right, thanks, Will. That's some great news coming out of the market. We needed some good news, didn't we? So we got some. If you got questions for retirement, or if you got questions for your young people just entering the market about how to save and what to do, check out CentauraCapital.com. It's where I keep my money. It's where we're planning for our own futures. Sure. So we want your families to invest and have success long term.
Yeah. Sounds good, bud.
We'll check it out. And then don't forget to look for updates. We're going to be doing this on the regular so we know what the market's doing. It's a convoluted world, so you want to know people that actually have your back. CentauraCapital.com. Check it out.